Welcome to the CashStream Financial video, an introduction to invoice discounting. My name is Tim Lee and I am the CEO and founder of CashStream Financial. I am also the co-author of a book about factoring and invoice discounting, which was published in the UK. This video is part of a series of videos relating to commercial finance which are available to view in the Learning Centre of our website, cashstream.com.au. So let's get started. What exactly is invoice discounting? Invoice discounting is called many things. For example, cash flow finance, debtor finance, and invoice finance. It has developed out of the factoring industry by providing the key financial benefits of factoring, in other words, the finance that grows with your business, but without the disclosure of the lender's involvement being seen by your customers. Essentially, invoice discounting provides finance against business-to-business invoices without your customers being aware of the lender's involvement. So how does it work? Essentially, invoice discounting is very simple. A company raises its invoices to its customers in the normal way. Details of those invoices are sent to the financier. After assessing the invoices, up to 90% of the value of the invoices is made available on day one. The customer then pays the invoice discounter via a trust account. The invoice discounter then returns the remaining 10% of the invoice values back to the customer, less their charges, of course. It's almost as if a company borrows its own money. So let's look at the facilities available in the marketplace. The facilities available depend upon the risks of your business and the quality of the security being offered. In other words, the nature of your invoices. The greater the perceived risk, the more likely the facility will be on a disclosed basis. In other words, your customers will know the invoice discounter is involved. Now, as risks reduce primarily through good profitability, so confidential facilities become more likely. There is actually a halfway house called confidential factoring where the invoice discounter runs a parallel sales ledger to the client company. Finally, there's a relatively new entrant into the Australian marketplace called asset-based lending, where additional assets are also funded. For example, plant and equipment, property, and inventory. You may want to go to our Learning Centre to look at our video on asset-based lending for more details on this facility. So how does invoice discounting fit strategically into a company's financing plans? Invoice discounting is more suited to established companies that have developed good quality operational and financial systems. An invoice discounter is going to want to know that you are able to control your business in the collection of your invoices, which represents their security. So if you've been through the early stages of growth and through the pain and instability associated with that growth, and you have developed good quality operational and financial systems, invoice discounting will be more appropriate for you. Okay, let's look at the other options available for expansion and compare them to invoice discounting. Any expanding company needs additional working capital to fund stock, wages, overheads, etc. And the faster the growth, the more working capital is required. So what are the alternatives? Well, you can have a look at equity. Maybe you have some savings to put into your business. The question is, do you want to? Especially given the uncertain market conditions and also the credit crunch. You could look at external equity, but of course this means giving up a percentage of your business. The alternative is you could look towards offering additional security to your bankers to increase the overdraft. The question is, do you have additional security, and indeed do you want to pledge that additional security? All the above facilities are equally valid, and it depends upon your own risk profile. One thing to bear in mind is that in terms of uncertainty, best practice usually suggests keeping some powder dry, just in case. And the other thing to bear in mind is it's easier and cheaper to raise debt when you're not desperate for it. So let's see how invoice discounting compares to a bank overdraft. Bank overdrafts, by their very nature, are fixed, usually against a fixed asset, usually real estate. But growing companies need additional capital. So what you might notice is your bank overdraft limit gets hit regularly. You get those phone calls from the bank manager. Often there is a core level of borrowing that is being seen, usually very close to the overdraft limit. With invoice discounting, on the other hand, as soon as you raise invoices, you get cash, up to 90% of the face value of the invoices, usually within 24 hours. So the more you sell, the more your finance facility grows with you. Of course, the opposite occurs if your sales fall, so a little caution is sometimes required. It is usually best practice to have some form of working overdraft facility just in case. The beauty of invoice discounting is that unlike bank overdrafts, one, you generally don't have to put up real estate security to support the facility, although you need to be aware a personal guarantee will be required, mainly to cover fraud. Number two, funding is against your current sales performance and not your historic balance sheets. And finally, the level of finance grows directly in line with your sales.